Hey everybody, welcome to the Rochester Real Estate Show podcast. Jason Mancuso here with the Anthony Butera team. As always, got a special episode today, joined by Chris Stevens and Lisa Roberts of Premium Mortgage. We are going to tackle the relatively hot button topic that's hit the news cycles in the last couple of weeks. I don't even know how to describe it. I mean, essentially, the news cycle is government, whatever you want to call it, has made it harder and more expensive for those with good credit to buy a home and made it cheaper and easier for those with poor credit to buy a home. And, obviously people get fired up on that. I will tell you right now, if you're tuning in to get some political commentary or anything like that, you're not going to get it. So we're here to provide detail, clear the air, do some Mythbuster type of stuff, and hopefully it helps. So who wants to start here? I mean, I think, what I can kind of lead with is all this is around the acronym is LLPAs, which are loan level price adjustments. I'm going to put it in your guys' court. What the hell is a loan level price adjustment?
Yep. So I think before we talk about it, to give a little history of how we got to the loan level price adjusters, I think everybody's familiar with Fannie Mae and Freddie Mac, which are the conventional mortgage agencies, which most lenders sell their mortgages to. So before Fannie and Freddie were around, it was literally in the 1920s, when you'd have to buy a house, you'd go to your savings and loan, you'd get a mortgage, and it was probably a 10-year mortgage. And that's how your financing was done. People would deposit money in the bank, they would lend that money out in a mortgage. When the Great Depression hit, and I think it was 1938, the housing market crumbled because those small lenders weren't lending money. So the government stepped in and created Fannie Mae in 1938 to add liquidity to a market. They would tell the bank, if you lend for the mortgage, sell it to us, we'll give you the money back, you can lend again. So that's how Fannie Mae started.
Okay.
And there were no loan level pricing adjusters back then. It was just simple mortgages. And that's how the 30-year mortgage started, was in 1938. Prior to that, it was all short-term mortgages. So the long-term 30-year mortgage started right around 1938 when Fannie Mae was created. Everything went along great. There were some changes made. The next biggest thing that really happened, like for people on this call, was in the 90s. In the 90s, private investors started getting in the market because they saw how profitable mortgages were. So things like, Lehman Brothers, Countrywide started getting into the mortgage business more and more. And they're like, all right, these 30-year mortgages are nice, but maybe we can start lending to lower credit score borrowers also. We'll take that risk. Maybe we can do things like, hey, you've got a really good credit score, but you're self-employed and can't show income, we'll lend on that. So they started doing riskier mortgages in the private industry. Fannie Mae.
Sorry to interrupt, up until then, it was just like great credit was the only option to get a mortgage.
Pretty much, yeah. It was,
okay.
If you had bad credit, it was hard to get a mortgage.
Got it. So do you know what the cutoff was? 700?
I don't even know what it was back then.
Yeah. No, that's interesting. I didn't know that. Continue.
Yep. So Fannie Mae, they're a for-profit. They're like, wow, we could be doing these private investors are making all this money. Why don't we step into that realm as well and expand what we're doing? And as well, the government, they want to put people into homes. So they're like, a lot of the first-time home buyers have lower credit. So we're going to help those people as well. So we're doing a service for everyone. So Fannie Mae and Freddie Mac, who's the other agency, started doing low credit scores. They even got into what we call the Alt-A, alternative credit. That's where you had a good credit score and no income. And they started lending themselves with that, which that was all going great. Then, as we all know, the housing crisis hit in 2008.
Yep.
Because what happened was housing prices were going up. There were all these different type of investment product and vehicles to get into mortgages. And when the home prices started going down, people started foreclosing.
Right.
So Fannie Mae at that time was undercapitalized and overexposed to risk in 2008 when everything started collapsing. So they couldn't go away because then the whole mortgage industry would just collapse. So the government stepped in and said, we're going to lend. We're basically going to take this over, but we're going to add what we're going to call loan level pricing adjusters to now take care of this risk that's out there. So they layered I don't know they layered the fees that they would charge to everybody. Basically, nobody was getting a 0 fee rate. I mean, unless you were like a 790 credit score with, 60% down, 70% down, there was a fee for everyone added now to these interest rates. And they would go up. The lower your credit score was, the higher the risk. So the more the fee was. And that's basically how these loan level pricing adjusters started, was in 2008. And there was a lot of news about it when it came out, a lot of talk about it in the real estate industry. And then it kind of went away. Like, it just became standard operating procedure. This is what it was. Nobody really talked about it. And the pricing was the pricing. We'd get a call from a borrower. We'd go through it, see what their credit score was, what their loan to value. And these adjusters were kind of done in the background when we would get the rates, and we would, your rate's 6.5, or, oh, right, your better credit score, your rate's 6.25 kind of thing. And we all did the job. Nobody talked about it. It wasn't in the news. It wasn't even a thing. And all of a sudden in January of this year, they made an adjustment. We call it the grid, where all these things are. And I think we're going to show one a little later, where the changes were. They made changes to it that, I guess, people, and the reason it's politicized right now is people feel like it was done intentionally, I guess, to either whether you're Democrat or Republican to fix these things. But that's not the case. What happened was, again, Fannie Mae and Freddie Mac are in the business to put people into homes. And what they realized was a lot of these first-time home buyers who don't have a lot of money weren't getting the opportunity, especially as the home prices were increasing across the country during COVID. They were missing out. So to fix that, they said, we're going to lower these fees for the lower FICO borrower, and we're going to increase the fees for the higher credit score borrower.
Well, Chris, can I step in real quick just to clarify? But when they lower the loan level pricing adjustments for lower credit scores, it's specifically for first-time home buyers.
Well, there's two things.
Within a certain income bracket.
Right. So, correct. So they lowered the score for the lower FICO borrower, whether you're a repeat homeowner or not. And what Lisa's saying is, they also said, if you're a first-time home buyer, which means you haven't owned a home in 3 years, and you make below the area median income, which in Rochester is about I think it's 91,500. All of those loan level pricing adjusters will wipe them out. You don't even have to pay them. So the first-time home buyer that makes less than 91,500 in Monroe County is going to get the best rate, better than anybody, basically, even if their credit score is a 680. So that's how Fannie Mae is saying, we're going to help. They want to create wealth, is what people say, by, people who own a home create wealth. You get home equity. Right. So that's what they're really trying to do. That's been their whole mission the whole time. It's kind of why we also talked during COVID, they increased the loan level pricing adjusters for investment properties and second homes, because they basically said, that's really not our main business. Our main business is for primary residence. So that was the last adjustment that was kind of talked about, but not as much as this is.
Makes sense. Couple questions before we get further in the weeds. So the historical aspect there, up until 2007, 2008, was Fannie and Freddie not, I guess, either owned or backed by the government till that point?
They were, it was an implicit backing by the government.
Gotcha.
They were public companies, they had stock, but it was always thought that the government stood behind them. Like, they weren't going to let them fail. I mean, the housing industry in the country would collapse if Fannie and Freddie collapsed.
Right. And are they now then, since then, or is it still?
So then when the Federal Housing Finance Agency took it over in 2008, they basically created another government division and said, we're going to take you guys over. They still have public stock, but basically the government now runs them both.
Okay.
In like a big bank, they'll never let them fail.
Right.
You can say never. 99.9%, they're not going to go away.
Well, critical to the housing industry, like you said. So if that would have, hit the fan like everything else did, 15 years ago, then it would have been that much worse, right?
Yep.
Another question. So and we touched on it a little bit in terms of these are conventional loan products that it applies to. FHA, VA, buyers and loans, this is not even a conversation?
Correct.
Okay,
This is just for conventional borrowers. So obviously every mortgage has a risk to it based on the whether you put more money down, credit score. The way FHA handles risk is they just charge an upfront mortgage insurance premium. That's what they do to handle risk. They don't layer it with these loan level pricing adjusters. They'll adjust their insurance premium. That's how they do it. Same with
Gotcha.
VA. So
Gotcha.
this just applies to conventional mortgages.
okay,
So I'm going to step in and talk about that a little bit because you may have, heard me before mention, somebody, let's just say, for example, their 640 credit score with conventional, and I know you're going to pull up the loan level pricing adjustment grid in a little bit, so you'll be able to see the adjustments, but it's tiered basically by your credit score. So there's different categories for your credit score. So somebody, a 640 credit score previously, we might have said, you know what, it's going to be way more affordable for you to go into an FHA loan because the rate is going to be so much better and you're not going to have these loan level pricing adjustments. Whereas now that 640 credit score might have a little bit of a better opportunity. Like Chris mentioned, if they fall within a certain income limit, now they have an opportunity to go conventional and be able to have a more affordable loan.
understood. Options are there. You got to look into them just like with everything, right?
Yeah, it's very difficult. Like what has really changed with this now is it's to just say, a lot of people are like, what are the rates today? It's really hard to just say this is the rate because a lot's going to depend FICO score, your loan to value. Are you a first time home buyer? Are you below this income level? There's a lot of variables now. So, it's really, here's the range of where rates, we're in the mid sixes, low sixes. But to really get specific on a rate, you really need to talk to your loan officer to get that.
Yeah. No, we always, when we're in conversations with buyers or even our agents, like you can't just call up call 5 banks on a Tuesday and hey, what's your rate? And then go with the one who tells you the lowest rate.
Yep.
If they're even rattling that off, they're just full of it, right?
Correct.
To a degree.
Yeah, like a lot of lenders used to put their rates on their website, and what we're
Right.
seeing now is a lot of them are pulling them off their website because it's just
Sure.
too hard
Sure.
to have them up there.
And,
All right.
and this is good for consumers just to kind of understand too. So I am glad that you're doing this because, consumers also need to ask questions. And I'm just going to kind of give you another scenario. I spoke with somebody yesterday. They called me to get a quote. They were, shopping me against another lender. And they were just told, this is how much you have to put down and here's the rate. But I kind of gave them options and said, okay, well, you're putting 20% down, but here's what it looks like if you put 25% down. Here's what it looks like if you put 30% down. And, he had mentioned that the other lender never even gave me those options. So consumers kind of have to understand this so that they can ask those questions. Well, what if I put more down?
Right.
Because those kind of things do make a difference in sort of lowering the rate.
Well, I think this is we do a lot of topics on this podcast, but and a lot of them have the crossover to consumer information and agent information. This is one that, frankly, not disparaging other agents, and I'm not the expert, so I needed this too. But this is this level of conversation for most agents is like, what are you talking about, right?
Right.
It's important for everybody, in the agent community to listen to this and just have a general understanding. But ultimately, consumers, you need to get with, shameless plug for Lisa, somebody like Lisa that's going to explain all the options and not just, you're looking at 6.25 on a 30-year conventional loan with 20% down. That's it. So yeah, good stuff. One clarifying question, I think, before we really get into it, is this, so the LLPAs, what we're talking about ultimately, is this related to the interest rate itself, or is this a closing cost, or both?
It's,
I would say both.
I would say it's both. So it's a fee, but most people pay the fee in the form of a higher interest rate.
Got it.
Because does that make sense?
Yeah. So you have the choice to pay the fee up front, and we'll show the chart that
Yep. Correct.
goes through what it could be, or you can build it in to the cost of the loan in the form of a higher interest
The
rate.
higher interest rate, which is what most people do.
Okay,
Yeah.
got it. Like 90% of the time.
I would say so, yes.
Yeah. So most people are looking at it like, if it's just throwing out a number, 2%, $300,000 house, it'd be an extra $6,000 at closing, or roll it into a higher interest rate.
Yeah, like, so depending on what the loan level pricing adjustment is, it could make a difference in like the rate. Let's just say if you roll it in, the rate might be 6.5. If you pay it out of pocket as part of your closing costs, the rate might be 6.25. I'm just using that kind of as an example, but that's how it works.
Right. I got you. Good stuff. Why we're on this topic, like why this happened, is just the overall mission to promote affordable housing. Right.
Correct. Yep.
Yeah.
Yes.
And then the news plays out when it quote unquote penalizes.
Right. So that's always been the role of Fannie Mae and Freddie Mac, is to help home buyers get into a house.
Sure.
And again, as the home prices were going up, people with lower FICO scores and first-time home buyers historically didn't have a lot of money, so they had lower down payments and lower FICO scores. So when these home prices went up, they were getting pushed out of the market. So that's when Fannie and Freddie and the government stepped in and said, we got to help these people. Our mission is to help people build wealth and get them into a home. That's why they reduced the fees for the lower FICO scores. The media, I guess why this is a hot topic, misunderstood or tried to explain it in a way that fit their narrative of what they wanted to. So what they came out with and said, the lower FICO scores getting a discount and the higher FICO scores paying for it, or you should let your credit score go down so you can get a better interest rate.
Yeah.
All of that is a complete fallacy.
Yeah.
What has happened, I guess, to put it into simple terms, is the person with a lower FICO score still has a higher rate than a person with a higher FICO score, no matter what, unless they're a first-time home buyer under that median income limit.
Yeah.
What happened was the lower FICO scores interest rate went down a little bit for them with this change. Like Lisa was saying, instead of 6.75, maybe their rate 6.625 now, or 6.5. For the higher FICO score, where they got hurt was their interest rate still lower. Say it was 6.375 or 6.25. Now it might be 6.375. Still lower than the higher FICO score. Granted, the fee went up, but it's still lower, which we'll show on that chart, than the lower FICO score person. I know it's like we keep talking higher, lower, but it gets confusing. But in no way did the higher FICO score borrower get a higher interest rate than a lower credit score buyer, if it's apples to apples.
Well, and really to summarize, like what you need to know as a consumer or an agent advising a consumer, don't read the news headline and then go out and miss your next 4 credit card payments, so your credit score drops 100 points. So I can take advantage of this news, right?
Right, because those were the headlines.
That's all we need. Yeah, exactly. That's how it comes across, right?
Right.
I mean, we can end it right now. Just that's what you need to know on the consumer end of it. You're still getting a better deal, rate, fee structure, whatever you want to call it, with better credit.
Correct.
Yes.
100% of the time.
100% of the time.
Yeah. And this is all pre-existing. I didn't know this, that like it came out, after 2008. Makes total sense.
Yep.
But since then, pre-existing fee structures, rate structures.
Yep.
And they're just tweaking it, is the way to look at it, right?
Correct. And what's interesting is these changes were announced in January of this year.
Right.
Most lenders put these changes in place 60 to 75 days ago with not even talked about. Nobody mentioned it. Borrowers didn't notice. It was just business as usual. I guess, and I don't want to get too deep in the woods, but what the May 1st date was, which is why it's in the news right now, was when loans are delivered to Fannie Mae,
Right.
sold to them. So when most lenders do a mortgage, the average time frame in Monroe County is 30 to 60 days for a closing from application date. So when we take that mortgage, we go through the process, we close it, and then we sell that mortgage to Fannie Mae. We might service it, collect the mortgage payments, take care of your escrow, but the investment itself is the mortgage that's what gets sold to Fannie Mae. And that's the change that took place May 1st. But since it's sold, all those mortgages that were being taken 2 months ago, these loan level pricing adjusters had to be in that pricing then. So we've been doing this, every lender basically has been doing this for a couple months now.
Yeah.
With no mention of it.
Well, and it's just comical to a degree because I remember this somewhat of the news coming out whenever it was coming out, whether it was January, December, and just okay, whatever, another
Right.
banking world change, like it happens, every day or every week, it seems like, right? So
Exactly.
it gets, but now it's a topic because of just whatever you want to call it, the media, the politicizing of it, and it gets people's attention. And it, again, we're not going to get into it. It pisses a lot of people off, and there's
Yep.
certainly a benefit that's trying to provide, but it's just you got to dig into the truth of it, right?
Yep.
So probably a segue into these charts to actually look at some nitty gritty numbers of what this actually plays out for.
Yeah.
Does that make sense?
You
Sure.
have one to pull up, or do you want me to?
No, I got it all ready to go here. Do you guys want to look at the final rates, I guess, or the changes first?
Start with the final. 'Cause
Okay,
and then we'll show like the heat map, I guess we'll call it, what those changes were.
got it. All right, here we go. You see me?
Yep.
Yeah,
So this is the overall rate, not reflective of the changes themselves.
Correct. So those are those are the loan level pricing adjuster fees that everybody talks about. I
so
guess
those are kind of what we were saying, like would get built into the rate. So you can see over on the left-hand side, when I talk about the rate is different tiered based on your credit score, you sort of fall into that bracket depending on what your score was. And then you match it up with how much the customer's putting down. And that's how we determine like what the loan level, adjustment would be.
Now, you mentioned it before. I mean, if you're putting, I don't know if you can see my cursor here, but if you're putting 40 to 70% down or 70% or more down payment, you're not even, this isn't even applicable unless you're in that scenario and you're lower than a 640, 639, right?
Right, because the government basically said you got so much equity already into the home, the
Yeah, we
risk
don't even
level
care.
is non-existent for them.
Yeah. Now, one question I think that would come up is this is not, so like on the extreme end of it here at 2875, that's not like plus the rate, right? That's just a fee structure, I guess is the way I think of it.
Yep, that's right.
Right,
It would
so
be,
don't look at this and think like, oh my God, my rate's going to be almost 3% higher because I have less than a 640 and I'm putting, 15 to
Right.
20% down.
I would say the best way, maybe the easiest way to describe it is, let's look at the 740 FICO score, putting 40% down. They have no loan level pricing adjuster,
Right.
right? So they're right between that. So let's just say that interest rate is 6%.
Yep.
That same scenario, but they're only going to put 20% down. So if you slide down that same thing, it's a 1 right there. So now there's a 1% fee. So what that equates to in rate is, instead of 6%, that rate's probably going to be closer to 6.375 to 6.5 for that borrower.
Okay.
Or they could pay 1 point, that 1%, and get the rate back down to 6%.
So got it. So if it's a $400,000 house, they can pay an extra $4,000 at closing, or they can have an extra, whatever it ends up being, 0.3 of a point over
In
the
the
rate.
right.
Right.
It would probably be about $60 more a month on a $400,000. Now you take that same scenario for someone with a 660 FICO score that's putting 20% down. Their fee is 2.125, which probably equates to, in this scenario, 6.75 to 6.875 in rate.
But we're talking almost 10 grand extra if you're going to cover it.
Correct. So you can see, like, so And we'll show the difference. So the lower FICO score, their fee went down, but it's still, as you can see,
Oh, yeah.
1.8% higher than the higher FICO score person.
Yeah, I mean, just look at this, kind of 75 to 80% loan to value, or, great credit, not, significantly lower than a point, poor credit, almost 3 points.
Right.
But
So-
as you can see, like while we're talking about that 640 customer, we're talking about the 20% down, that adjustment is 2.25. But if you look at the minimum down, which is 9.5, that's kind of where they benefit is, they're getting an opportunity to sort of get a better rate because of the lower credit score and just minimum down. Again, just opening up the opportunity for those customers to be able to have a more affordable home.
So I think somewhat of an obvious question, just looking at this heat map is, why is there an advantage to putting less down in these scenarios? Compared to like you would think 20% down type of buyer is a great buyer for the lender, right? Compared to, minimum down payment.
Yep. So as soon as you put less than 20% down, mortgage insurance kicks in. You have to pay mortgage insurance. So when you pay mortgage insurance, that takes risk away from Fannie Mae and Freddie Mac. Because now if there's a foreclosure, you're not making your payments, the mortgage insurance kicks in to pay that. So when you put less than 20% down, I know it's counterintuitive, but the pricing actually gets better. Because but you're also paying a monthly payment for your mortgage insurance. So your rate might be better, but you're also paying a little more for your mortgage payment because there's the added cost of the mortgage insurance. And again, that's where you would talk to your loan officer, you would talk to Lisa and see what's best for me. Is it better for me to do 20% down with no mortgage insurance? Or what if I only want to do 10% and had mortgage insurance? What's my cost there? Because sometimes it is better even with the mortgage insurance.
You're paying for risk related fees no matter what.
Correct.
Because if you're 25% down, no mortgage insurance at that point, but you have, the highest on this grid, you go higher down payment, it comes down. Higher than that, it comes down, versus lower than 20%, it goes up, because you have the mortgage insurance charges would kick in here.
Right. So the fees go down for the loan level pricing adjusters,
Right.
but that's because there's the added factor of now you have mortgage insurance on it, which helps protect Fannie Mae and Freddie Mac. It's less risk to them for that mortgage.
And to rewind the tape, all of this is a result of how messed up things were banking mortgage wise, before 2007 and how we got to that point. And then,
Correct.
really not managing risk properly. And then the whole thing burning down. And here we are.
Yep. I guess the best
can't avoid banks and the government charging for risk at this point. Never will again, right?
Never will again.
Sure.
I can just like whenever the government puts something that it never goes away, even though they say it might, it's never, it won't.
Right.
And the way I like to explain it to people, it's just like your auto insurance. If you've had 0 accidents and you're an older driver and you've owned a couple cars, you're going to get the best insurance rate. If you're a new driver and you've had an accident, you're a lot riskier. Your auto insurance is going to be a lot more.
If you've had 10 accidents, it's going to be even more.
Even more. And
I love that analogy. It makes perfect sense.
Pricing.
That makes perfect sense. I think, that's the way to think of it, to clear it up on the consumer and the agent side of it. Think about how your car insurance works. If you've had 10 accidents, 10 speeding tickets, you're going to be paying a lot more than the person next to you that's had a clean driving record for all their life.
Right. So if you've missed a couple credit card payments, you have a lot of debt, your credit score is low, you're riskier, you're paying more.
Love it. Anything else to discuss on this overall heat map with the overall rates?
I think this basically shows though that it debunks that myth that you see in the news that the higher FICO scores paying, getting a worse rate. They're certainly not.
Well, and again, like I said too, that don't go and ruin your credit from a 780.
Correct.
You're going to take advantage of this news because look at how it's going to affect you.
Yep.
And then I'm not sure if you're gonna kind of get into this and show, there's another, on top of this loan level pricing adjustment, there's other adjustments for things like type of property. Is it a 2-family, a 4-family? Is it a second home, investment property? So there's a
Yeah.
whole nother chart of adjustments.
Right. Yeah, no, I didn't see those. I saw the refi chart. I figure I keep it to purchases here, given what we're doing and what we do the most of. But that's important to know. This
Yep.
applies and applies differently no matter what mortgage you're getting.
Exactly.
Correct. And I think and I know we don't really have the chart, but the reason, like when we talk about second home and investment properties, people are like, well, why would my rate be higher for those? And the reason that is they look at it like if you were to lose your job and you have a second home, the first thing you're going to do is stop making your payment on your second home. Sure. That's the home that would be foreclosed on first, not your primary. That's why there's additionally layered fees for the second homes and investment properties.
So essentially just know that anything second home investment is going to be a higher. I mean, that's kind of baseline anyway. You're going to have a higher rate for anything other than your primary residence. Cool. These are the changes. See what I see?
That hasn't popped up yet. These are still the old. I think it's coming up.
New to Zoom here. Hold on. With me?
Yep.
Yep, see it.
So these are the tweaks that they made. And essentially, I'll take a stab at it, I guess. Green is bad in this case, right? In terms of going up.
Green is actually good in this case.
Oh, I'm sorry. Yeah. You're right. Green is good. Yeah, obviously. Yep. Green is good going down. That was backwards. Yep. Red is going up.
Correct. So in the example we used before, you can see that 740 FICO borrower with 20% down, their fee went up 0.75%. Yep. It used to be 1/4, now it's a 1 point fee. And for the 660 borrower, it went down 0.625. So it was 2.75, and I think now it's 2.125 for that borrower. Again, they got a break, they're paying less, but they're still paying more than the higher FICO borrower.
I mean, to me, the way I look at this is like, okay, yeah, news, tweaks, changes. I guess to get past it, mindset wise, it's irrelevant based on what we just looked at on that last chart.
Correct.
I mean, just you have a good credit, you're going to get a better fee structure. You're going to get a better rate, period.
Yes. This is the chart that the news is using to talk about. They're saying that lower FICO borrower is getting a break of 0.625 and the higher is paying 0.75. But that's the wrong way to look at this chart.
Yeah.
This is just showing you the changes in what is already being paid.
And I think the news cycle is so dangerous in that, like, people can look at this chart and not know, and then like, oh, great. All this work I did to have a 740 credit score and put 20% down, and now I got to pay 0.75 of a point of a higher interest rate.
Right.
That's not true either.
No, not at all.
I mean, this is extreme here. This is.
But this shows.
2 point.
Yeah, that's a lot. That's a hard mortgage to get. That 620. There's not a lot of those getting done. I can tell you.
Oh wow, I didn't even notice that. That's 620.
Yeah.
Okay. Yeah.
Those are difficult. But I think what this chart would show, though, is it kind of shows what the government and Fannie Freddie are trying to do. If you can see where all the green is, it's for the lower FICO borrower putting less money down.
Right. Yep.
Those are really the people that they're trying to help right now.
Sure. Well, and again, the overall stated mission is to promote affordable housing for obvious reasons, which, I mean, I don't know why there's
it's good for all of us.
So much of a problem with that, I mean, why wouldn't people want to, or why wouldn't the greater good be for everybody to own a home, right? So,
correct.
I get, here's a question I think is coming up. The concept of the term subsidizing. So the higher credit score is subsidizing those with the lower credit scores. Thoughts on that? Truth to that?
I would say that's kind of truthful. Yeah. I mean, the pricing went up a little bit to help probably cover the cost of those fees going down for the lower FICO borrower.
So yes, but I also think of it as like it was there before.
Right. They were still paying a fee.
Yeah.
They're just paying a little more now than they were, the higher FICO. And the lower FICO is paying a little less, but still costing them more overall.
I think that's what, an element of what gets people fired up on this. But take a step back a bit, you're still paying less. It's not flip-flop to where you're now paying substantially more overall compared to somebody with 100-point lower credit score than you.
Yes, correct. And I think that's where people, I mean, and that's, again, it gets politicized. Why would I subsidize this? But that's, I think that's just the nature of the beast in everyday life. It happens all over the place.
Yeah.
I mean, if you look at your basic income taxes, the more money you make on average, the more taxes you pay. The higher your tax rate is, you're subsidizing the lower income person. It's just how our government has set things up, whether you like it or not, whether you're Republican or Democrat. It's just, that's the system.
Yeah. Move to China. See how that goes.
Right. But again, the news puts out clickbait and things like that to try and get people onto their site. And a lot of it's just misinformation.
Well, I mean, in a way, it's a silver lining, I guess, in terms of like we as agents were essentially forced to get educated on this topic. And I'll be honest, I've been doing this 10 plus years now. I didn't know anything about LLPAs prior to this,
right,
and how it works and what it is. So this is, there's good elements in that regard. But yeah, I mean, the clickbait that's out there, the new, just everything that, we don't need to get into it, but how it's designed, like here we are, and it's important to dive into it like we just did.
Yep. I mean, I think overall the changes aren't bad. I think it's a good thing.
Yeah.
I mean, does it stink that somebody's maybe paying a little more that's got good credit? It does, but you're still getting a better rate.
Yeah,
and
but it's
helping
also
more people get into a house.
It's also relative, right? Like if you're buying a house now, so now you're subject to this fee structure. You didn't buy a house prior to now.
Right.
You were still subject to that fee structure then.
Correct.
You didn't buy a house 2 years ago when the rates were half of what they are now.
Right.
You get over it. They need to buy a house or not, I guess, right?
Yep. And those were the good old days, those 3% rates.
Yeah, no more. No more. Never again. Well, anyway, likely. Good stuff. I think covered everything on my list. You guys have anything you want to add? This was perfect.
No, I think we just put out a blog post too on our website. If anyone wants to go to it, I think we sent it out to a lot of the agents today. And if you just go to Premium Mortgage Corp on our website, there's a letter in there that Mike wrote that kind of discusses this in more detail too.
And we'll get this out there on all our channels and get the agents educated around it, get the consumers aware of it. Just stop the clickbait. We'll put out some clickbait too for this, but
yeah. And again, I think the best thing to end it is that if people have questions, you just got to call your loan officer.
Yeah,
and they can explain this.
Well, yeah, generally speaking, right? If you're making decisions on what you see for anything on headlines off the news, it's probably not a good thing this day and age. So yeah, call the experts, call the people that you trust, and obviously there's two of them right here in front of me. So take advantage of it. So this was absolutely perfect, guys. Thank you so much for your time. Again, Chris Stevens, Lisa Roberts with Premium Mortgage, Jason Mancuso here with the Anthony Butera team as usual. Thanks for tuning into the Rochester Real Estate Show podcast. We'll catch you next time.